Good morning and welcome to the Nayfeh webinar series, providing you with timely information and training on topics of interest. My name is Brian Money and I'm the Program Manager for the Business Development and Strategic Partnerships Department at Nayfeh National. Today we are presenting Understanding Financial Aid Award Letters, sponsored by Sallie Mae. With me today is Nayfeh Trustee Brock Jolly, along with Carrie Bedford and Chad Pazorchik from Sallie Mae. With college tuition rates at record highs, a detailed understanding of the financial aid system and how to leverage it is a must. Today, our expert presenters will help you navigate the complexities of college funding and the admission process with a special focus on financial aid award letters. During the webinar, you may type your questions in the question box on the right side of your screen. And for your information, this webinar is being recorded. Carrie, welcome to the webinar.
Thanks, Brian. Good morning. I want to start on slide 2, just talking a little bit about our partnership with Nayfeh. This partnership was formed last fall for a couple of reasons. We recognize that amongst your clients, this is one of the biggest financial decisions families are going to make when it comes time to paying for school and higher education costs. So through our partnership with Nayfeh, we are providing access to your customers to college planning tools, and this will help keep your customers well informed on decisions they have when it comes time to planning and paying for college. Sallie Mae has been in the private student lending business for 43 years, helping America pay for college. We have 100% U.S.-based customer service in both origination and servicing. And together, through our partnership, we can help, again, your customers plan and pay for college. Also want to bring to your attention that and a lot of information on our partnership is on nayfeh.org/college planning. On slide 3, Sallie Mae does have a recommended approach when it comes time to paying for college. We encourage all borrowers to first exercise all free money that may be available to them. That could be in forms of grants, work studies, any types of savings, scholarships, etc. Once they explore those options, we encourage them to then look at the federal opportunities. Generally, with a federal loan, the interest rate might be slightly lower, and also they may have a little bit more flexibility over the life of the loan for repayment. Finally, the third bucket would be any gap that's still remaining, so you'll have that extra money that you still need to find. Here, we would ask, advise your customers to look at any types of PLUS loans for parents, for graduates, and also to look into the private education loans, again, available on the nayfeh.org website. And now I will turn it over to Chad.
Thanks, Carrie. I'm going to speak a little bit about financial aid award letters and the way schools kind of present them to students. Later in the presentation, we're going to walk through an example of what that award letter looks like. There's no real standard format in which a financial aid award letter has to look. Each school packages it uniquely, but essentially what that award letter tells the student is how much college is going to cost for that particular year, any financial aid package that school is offering the student, and then finally, what's that true cost of education and how much of that cost will be, responsible for the family and student. How much are they going to have to come up with out of pocket, if you will. The financial aid award letter is going to really demonstrate that. And we know through a study that we conduct annually on how America pays for college, 24% of families consider the school based on the financial aid or how much it's going to cost them. So it's a big piece of the puzzle. Our webinar today is very timely because today is National Decision Day. And that's the day where students select which school they're going to attend. And I'm going to turn it over to Brock now, and he's going to kind of walk through how awards are determined.
Perfect. Thanks, Chad. So this is really, from my perspective, the starting point in the financial planning process when it comes to college. As Carrie said, using that 1, 2, 3 model, I literally had a conversation yesterday with parents who had just had their daughter accepted at a really great school. It also happens to be my alma mater, so I'm a little biased. But for a variety of reasons, they hadn't saved up enough money, but they did have a little bit of savings. and they were looking at how do we use our savings, how do we go and get the Stafford loans, and maybe they didn't qualify for any need-based aid, but how do we make up the gap? And by their planning, they were kind of looking at it and saying, you know, we've got a gap of probably $8,000 to $10,000 a year. How do we do it? And I was able to talk about strategies where they may be able to save a couple extra dollars, some things that they could do with 529 plans to maybe save some money on taxes, and then say, here's how we're going to fill the remaining gap using the Sallie Mae loan program. So I think it's a perfect segue into what we're talking about today. So let's start with talking about how awards are determined. So most of you are probably familiar with a form called the FAFSA. FAFSA stands for Free Application for Federal Student Aid. And if you're not familiar with it, go to the website FAFSA.gov. If you have any challenges with that, you may also try FAFSA.ed, as in education.gov. Both should work, but just in case. And there have been some changes with the FAFSA over the last few years. It used to be a January 1 starting date for completing the FAFSA. That has now been changed. It's now October 1st. And the other big difference is rather than looking at the prior year, the terminology that they now use is what's called the prior year. So as an example, for students who will be seniors next year, so seniors in the class of 2019, will be going to college in the fall of 2019. They'll be completing the FAFSA in the fall of 2018, but they will be looking at the income for the family as of calendar year 2017. So something to keep in mind when you're doing your planning. But every single college and university requires the FAFSA. And I'll go into it in a minute, but basically they're looking at 4 parts. They're looking at parents' income, parents' assets, students' income, and students' assets. And there's a formula that they use that determines that. There are also some schools that require a second form called the CSS profile. And the CSS profile is administered by the College Board. And I always sort of joke, it used to be that, the College Board is just a great resource. Probably when most of you on the phone went to college, it used to be that you'd go and you'd get the big thick book from Princeton Review or Kaplan or one of those outfits, and there was a page or two on every college or university. But the good news is that Al Gore invented the internet, and so now every single college and university has literally like a 15 to 20 page little booklet on the College Board's website where you can find loads of information about every single school, including what the costs are and how they meet aid and that sort of thing. Really, really good information on the College Board's website. Thirdly, some schools do also have their own institutional forms. And I think the key on this is you want to understand when your kids or your clients' children are applying to colleges, you want to know what forms they require. And if they require, the FAFSA is very cut and dry. It's very easy to understand. They're very transparent with what those questions are. The CSS profile and those institutional forms are a little more complex. The CSS profile, as an example, there's actually a pool of about 700 questions from which each school can ask 10. Now, they tend to be the same standard questions, but they're really just diving a little bit deeper, and I'll talk about that more as we go. Once those numbers go to the college or university, those schools come back with what is called a student aid report. And we'll walk through an example of that in a few minutes, but the student aid report basically tells the family, here's our first line in the sand in terms of what your aid offer will be. Now, that gets a little complex because there are big differences in how they provide aid. Some of it may be gift aid, like grants and scholarships. Some of it may be what I call self-help. Self-help is loans and work study, money that somehow, some way needs to be repaid. Again, we'll go through that in a little more detail. But what it's really doing is summarizing the data that was input by the family on either the FAFSA and or the CSS profile and or those institutional forms. And when you do the FAFSA, what you're coming up with is what's called the expected family contribution. That's the amount that the colleges and universities expect that family to pay per year. Okay, and I'll go through an example of that in just a second. So how do you apply for aid? The first step, like I said, is the FAFSA. I mentioned also that the CSS profile is required by about, I think the number right now is 229 schools. So if we want to get really detailed, they're going to ask more questions about things like non-custodial parents. So if you're working with a divorced family, the FAFSA only asks about the custodial parent. And that is, there's a series of questions. I won't go into it today, but basically they're looking at with whom did the child live the majority of the time? Number two question is who provided greater than 50% of the support? On down the line. A big misperception by families and by advisors is that it's only the parent who claims the child on the tax return. That's about question number 6 or 7 in the pecking order of who is determined to be the custodial parent. They also may ask questions about things like home equity in a primary residence, which is not covered on the FAFSA. Important for the context of this conversation, they may also ask about money that you have in terms of cash value inside of life insurance or annuities, which oftentimes is considered to be a non-assessable asset. But if the children are going to a school that requires the CSS profile, you would want to know if they ask about that. Obviously, by drawing that line in the sand and determining will this family qualify for need-based aid, that helps you to do some good planning, because there's a lot of misperceptions out there. Some families have heard all the sales pitches from the colleges and universities, and they think, oh, there's all this money out there. And the reality is they've never really determined. I have sort of a heartbreaking story. About 3 years ago, we were working with a family, and their son had his sights set on this one particular school, great school. He got accepted early decision, and therefore retracted all of his other applications. And then the financial aid packages came around, and they said, we're sorry to inform you, but you're not going to get any aid. And mom and dad were sort of flabbergasted by that. They said, we heard this great sales pitch, and they talked about how they meet 100% of need, and there's all these programs out there. And what they failed to understand was that their adjusted gross income was north of $400,000 per year, and that wasn't designed for them. They weren't getting any aid because in the federal formula, the way the Department of Education looks at it is they should be able to afford to pay for their children's college education. The first term with which to familiarize yourself is what's called the cost of attendance. Cost of attendance is your cost all in. So that's tuition, room and board, books, computers, supplies, the whole shebang. And again, you can find that information usually on the school's financial aid website, but again, collegeboard.org is a great resource for that. The second term I mentioned earlier, and that is expected family contribution. The cost of attendance minus the expected family contribution is your family's financial need. Said another way, that's the gap. That's the amount of aid for which your family is eligible. Now you'll notice I underlined, italicized, made red the word eligible, because what's critically important in this discussion is that doesn't necessarily mean that that's the amount of aid for which you're actually going to receive. Okay, really, really important. And the award may be different at different schools, and I'll give you an example of that in just a minute. Okay, before I dive into the formula, it's also important to understand that in the FAFSA formula, so again, this is most state schools. The exception is there are 7 state schools that require the CSS profile, if I can remember them. Those are University of Virginia, William & Mary, Cal Berkeley, UCLA, University of Vermont, University of Michigan, and University of Colorado. Did I get all 7? If your client's children or your children happen to be attending one of those schools, you want to know what questions they're going to ask. But with regard to the FAFSA, again, some things count, some things don't count. I won't read you this entire list. You can see it there on your screen, but assessable assets are things that you can easily get your hands on. Things like your bank accounts, your investment accounts outside of your retirement plans. If you own a business with over 100 employees, it counts. The other important thing is 529 plans are always considered to be an asset of the parent, whereas UGMA and UTMA accounts are always considered to be an asset of the child. And I think we all probably understand that well enough, but just to make sure it's totally clear, when the child turns 18 or 21 in some states, that is their asset. If they want to go jump on a Harley Davidson and cruise around the country. That's their money. They can take it and do whatever they want with it. I always joke with parents, most 18-year-olds don't know that, so we'll kind of keep it our secret, but it's important to understand. In terms of income, again, pretty straightforward: wages, rental income, business income, child support, dividends, Social Security, welfare, and the one that always jumps out to people, your current retirement plan contribution. So if you've got a family where mom and dad are each putting $10,000 a year into their 401k, their 403b, their thrift savings plan, et cetera, the Department of Education says it's going to come back into the equation. Essentially, they're saying you do need to save and pay for your child's education. You could always delay retiring a little bit longer. Not a popular thing when I say it at our workshops. Now, the good news is that all the money that's inside of your retirement plans does not count. So you could have a family with $1 million inside of an IRA or a 401k. It would not count in this formula, again, at most schools. So if it's a FAFSA-only school, they're not counting retirement plan assets. They don't count primary residence equity. They don't count money inside of life insurance and annuities. They don't count household items. So, if dad wants to put a new Ferrari in the garage, they wouldn't count it. Probably not a good financial planning strategy, but it wouldn't be counted in the college funding assets. Also, personal debt doesn't count. So whether it's mortgages or credit card debt or other student loan debt, that doesn't count in the formula. So if you had $100,000 in the bank and you owed $30,000 on the credit card, they'd count the 100, they'd ignore the 30. In terms of income, any financial aid, food stamps, pension rollovers, and any loans do not count in the formula. All right, public service announcement. I'm about to nerd out. I'm going to get really deep on this, but I think it's important for you as advisors to really understand it. Then what I'm going to do is I'm going to give you two resources. One is an online pamphlet that you can go to reference all of this, and the other is just a website that you can go to help families to calculate their expected family contribution. So hopefully everybody remembers the Griswolds: Clark, Ellen, Rusty, and Audrey Griswold. And Rusty's getting ready to go off to college. And so married family with 2 children. Like I said, Rusty's headed off to school. The older spouse is 50 years old, and that's really important to help you understand this. The parents make $130,000 a year. They paid some federal taxes. They've saved up $100,000 in assessable assets. So again, whether that's 529 plans or a brokerage account or whatever it may be, money in the bank, they've got $100,000. Now, Rusty did work a summer job, and he earned $8,500 in the, again, prior year. Paid a little bit of federal income taxes, and he's also saved up some money. And this is an important thing because a lot of times you probably have grandparents who may be trying to gift money to kids. Before they do that, beware of the potential risks to that. In other words, if you've got a family where maybe they will qualify for some amount of need-based aid, but the grandparents want to do something really nice, do the calculation first, because you may prevent them from being eligible for need-based aid if the grandparents are helping to pay for it. So in terms of the expected family contribution, again, it's a 4-part formula. So we said that their adjusted gross income is $130,000. You get an allowance based upon the income taxes paid, your Social Security paid, and they also give you something called the income protection allowance. Now, that income protection allowance ranges from about $18,000 up to just south of $39,000. For this particular family, which is a family of 4 with 1 child going to school, the allowance is $28,170. Now, you don't need to memorize that number. Okay, I just want you to understand how the formula works. If you really want to nerd out on this with me, what you can do is just do a quick Google search. Type in EFC for expected family contribution, formula 2018. What you will find, it should be the first result, is a riveting 36-page document from the Department of Education that will walk you through the entire formula. So it'll give you, if you're a family of 5 with 2 children in college, if you're a family of 3 with 1 child in school, all the different permutations that you may have, it'll tell you what the allowances is in one of those tables. So for this family, you can kind of see what the allowances are there. So their total allowance after taxes paid and Social Security, et cetera, is a little over $65,000, leaving them with $64,296. Then we look at parents' assets. Again, $100,000. Okay, you get an asset allowance. That asset allowance is based purely on the age of the older parent. So I would say this is where if you waited a little while to have kids, or if you married someone significantly older than you, this is where it starts to pay dividends. So in this case, we had a family, the older parent is 50. So for a 50-year-old, the allowance is $22,300. That leaves you with $77,700. That then gets multiplied by 12% to give you $93,224. Add those two numbers up, you get an adjusted available income of $73,620. Now, just like on your taxes, you take that number and you put it on the chart, and the chart says, okay, you're in this range, so what you're going to pay is $8,959 plus 47% of the amount over $33,100. Okay, now, please keep in mind, you do not need to memorize that number. Okay, and I warned you that I was going to nerd out a little bit here. I mean, that gets pretty deep, but I want you to kind of see how the inner workings of the watch come together here. This is what they're doing behind the scenes to get to a total parent contribution of $28,003. Then we're going to look at the child. Now remember, Rusty earned $8,500. He also gets some allowances based upon the taxes paid, the Social Security, and an income protection allowance. Okay, so his income protection allowance for, this is based upon the 2017 income, his income protection allowance is, I'm sorry, 2016 income is $6,570. Okay, so after the other allowances and the taxes paid, he has got $805. That gets multiplied by a rate of 50% to get to a number of $403. Then we look at assets. Every single dime that's in the child's name counts, and it counts at a rate of 20%. So in this case, he had assets of $15,000. 20% of that is $3,000. We add that to the 403 to get to a student contribution of $3,403. One of the things you may notice there is, remember that the parents' assets counted at a rate of 12%, but then that 12% got multiplied by 47%. So the quick math on that is that parents' assets only count at a rate of around 5.64%, whereas children's assets count at a rate of 20%. So again, draw that line in the sand first. If the family will not qualify for need-based aid, it doesn't matter where their assets are. But if they can qualify for need-based aid, it's critically important that you help them to understand some of the legal, moral, and ethical strategies that they may want to implement in order to maximize their need-based aid eligibility. Right? Carrie talked at the beginning of our presentation about how we can leverage some of the federal programs, and chief among them is need-based financial aid. So for this family, the contribution from the parents is a little over $28,000. For the student, it's a little over $3,400 to get to an expected family contribution of $31,406. What that means is that's the amount that the family is expected to pay for the following school year. Okay? Now, taking away from that for a second is this financial aid award. And so we talked early on about student aid reports. And what this is just a sample student aid report. And this is an example of how this might be received by the family. So the estimated cost, and you see there again that term cost of attendance, and this breaks it all down. Tuition and fees, on-campus housing, meal plan, books, supplies, they give an estimate for transportation, right? If this is probably someone who lives pretty close by. Some schools give a really low estimate because a lot of their students are, in close proximity. Some give a fairly high number because they might have students coming from all over the country or even internationally. So that's one variable. Same thing with, they may give you, in this books and supplies category. You see here with this example, they've got $1,000 per year. Could be high, could be low, depending on the particular student. Then they'll give grants and scholarships. They always want to give the good news first. Now, in some cases, like the example of the family that I spoke with yesterday, they didn't get any of what I call OPM, other people's money. They were not eligible for either need-based aid, nor did they qualify for any merit-based aid. So there was nothing here in terms of dean scholarships, presidential scholarships, the XYZ Foundation scholarship, or anything like that. Then we look at what I call self-help. And again, self-help is work study or loans. So in the loans category here, you may be looking at Stafford loans, right? They can be subsidized or unsubsidized. You could also be looking at even things in that category may be that they, and it shows here estimated remaining balance, and oftentimes they'll say, well, you can go and you can get a Parent Plus loan. And I can probably say this, whereas Carrie and Chad may not be able to say this, but there's a good legal term, caveat emptor, right, which means buyer beware, because the problem with the Parent Plus loans is, first and foremost, there's an origination fee. That origination fee hovers around 4.25%. Then the current interest rate on those loans is 7%. So if you've got a family where they may have good credit and they could go out and qualify for a student loan on their own, Sallie Mae is a really good opportunity to look and be able to take advantage of a really awesome opportunity. So the bottom line here is the net in this example is that this family is going to need to come out of pocket $16,000 per semester for the cost of education, cost of attendance at that particular school. And it says here, here's the different examples of ways that you could fill the gap. So let me go through with you again how this really boils down. And this is an example that we give in our workshops all the time. So this is a family with whom we worked a number of years ago. I've actually updated the cost of attendance, but this is a real world example of a family with whom we work. So the school on the left, public university, the cost of attendance was $21,625. On the right is a private college. The private college is triple the cost. So if you're a parent in Davenport, Iowa, and your child comes in and says, okay, mom and dad, I got into this great state school. It's going to be about $21,000 a year. And I also got into this private school that's $63,000 a year. Which of those schools do you think you might want to be buying T-shirts and hats and pennants for your child for? I think so often parents are looking at the sticker price, and the sticker price is not necessarily the price you pay. So for this family, their expected family contribution was $15,000, meaning that at the public university, the gap was $6,625. Now this particular school only meets 70% of need. What that means is they don't care where the other money is coming from. It's not coming from them. Of that, if you just keep flowing down that column there, that particular school meets 53% of gift aid, right? In other words, 53% of the need that they're going to meet is in the form of gift aid, money that doesn't need to be repaid. But the remaining 47% is self-help. Okay, so that's either loans or work study. So for this family, their out-of-pocket cost is their $15,000 expected family contribution plus the 30% that's not paid by the university. Then we add back in the self-help, again, because that's your money, that's loans, that's work study, add that back in to get to a net price of $19,166. Now, on the right is the cost at this private university. The expected family contribution doesn't change. It's still $15,000, making them eligible for $48,000 of need-based aid. Now, this particular school meets 100% of need. Of that, 86% is in the form of gift aid, money that doesn't have to be repaid, which is great. So that's $41,657 that never needs to be repaid, which is a beautiful thing. The remaining self-help of 14%, in this example, that was a Stafford loan and a small Sallie Mae student loan of about $1,300. So the family's out-of-pocket cost is their $15,000 expected family contribution. Then we add back in the self-help of $67.81 to get to a net price of $21,781. Now, you may look at that and say, well, gosh, Brock, for a financial advisor, you're not very good at math. But what you may not realize is we just took a school that on paper was roughly triple the price and made it almost the exact same price. So that's what's critically important to understand, is that this is a family that was eligible for need-based aid, and they took advantage of that opportunity. Now, a peek behind the curtain. Oh, I didn't do it? Oh man, my graphics came up. I'll give you a peek behind the curtain, and that is the school on the left is the University of Iowa. Now, the University of Iowa has about $1.25 billion in their endowment, which is a decent size endowment. But the problem is that they have about 34,000 students. The school on the right is a school called Grinnell College. Now, most of you on the phone have probably never heard of Grinnell College. It's this little tiny school in the middle of nowhere, in the middle of Iowa, which is a fairly redundant statement, but which I can say because I was born in Iowa. Grinnell College has about $1.8 billion in their endowment, and this school year they have 1,699 students. So the idea is, I get it that there's a difference between about 1.3 billion and 1.8 billion, but we just took a school that on paper was triple the price, and because it's a smaller student body, you can spread those dollars more among those students. That's why not only do they meet 100% of need, but 86% of it is in the form of money that doesn't need to be repaid. So if your families are eligible for need-based aid, you need to go out and find it and figure out ways that don't just look at the sticker price. So I told you I'd give you two examples of where you can go to calculate this. The first is doing that EFC Formula 2018 search on Google. The second thing is, if you go onto the College Board's website, if you just search in their toolbar, you can just look for EFC Calculator. You should be able to find it. I get feedback from people all the time because there's such good stuff and it's pretty dense on the College Board's website. If you have trouble, on our website, which is just thecollegefundingcoach.org, you can go, and in the upper right-hand corner, there's a big red button that says EFC Calculator. It'll take you to the spot on the College Board's website where you can calculate both the federal methodology. When you hear federal methodology, think FAFSA, and the institutional methodology. And when you hear institutional methodology, think CSS profile. So hopefully that's a good, maybe a little in-depth analysis of how the formula works, but hopefully that's helpful. And I'm going to turn it back over.
Thanks, Brock. That was great. We're going to talk a little bit about some loan funding options that are available. Some are need-based and some aren't. Brock mentioned the Stafford loan, and when Kerry spoke earlier, we talked about our 1-2-3 approach in funding and paying for education. We specifically call out the federal student loan market because interest rates in those examples typically are pretty competitive. And there's two options. One is a direct subsidized loan, and that basically means that it's need-based, number one. The student has to qualify for it. The family has to qualify for it. But really what happens in this situation, while the student's at school, interest is not accruing. The clock doesn't start ticking until they're finished school. So when you look at it from a family's perspective, they're paying less in interest for that loan. So that's a great option. The other example is an unsubsidized loan. Typically in that situation, the rates are competitive. They're very competitive, but families in that situation, they will have to pay interest back while they're in school. So there are two different options for undergraduate federal loans. We also mentioned, and Brock mentioned it, find other people's money. We do that through scholarships. And there's plenty of tools out there, happily on the nayfeh.org/college planning website. There is a free scholarship search tool that's available to all of you and all of your clients. I highly recommend you visit it and have your student or client register for it, because there's 3.5 million scholarships available on that site, and roughly it's around $24 billion in total scholarships that are available. And basically with that particular tool, a little plug for the tool, You go in, you register, you put some personal information there for the student, majors, their major, their GPA, race, religion, etc. It finds all the matches. It sends one email back and has a link directly there at one email for all the scholarships that are available to that student. Other types of ways to fill the gap is obviously a savings product. 529s are just a typical savings program, and tuition payment plan. Tuition payment plan are offered typically by schools, and that's basically paying as you go. So, for example, if there's a need of $12,000, you have $12,000 saved, they may be able to offer you a 6-month payment plan for that. But each school would have that. Finally, there are other options, and that's a private student loan. Talk a little bit about private student loans. There's a private student loan in which the parent and the student would both be responsible to repay that loan. And there's also a private parent loan, and that's basically giving the gift of education. So that parent loan, the student would not be on the loan, nor would they be responsible to repay that loan. We have, in partnership with Nayfeh, we have both of those products available to your clients if needed. It's on the nayfeh.org website /college planning. You'll see a little bit about the Sallie Mae loans available to your clients on the website. And then finally, Brock mentioned this earlier, a federal program, which is the Federal Parent Plus Loan. Again, Brock mentioned the origination fee of 4.27%, and it has a 7% APR. Also, just a point there is with that plus loan, again, that loan is with the parent and the federal government. The student is not on that loan. So if you want your student to have a little skin in the game, if you will, that loan is not the way to go. And it's also interesting to note, we talked a lot about the financial aid award letter, and each school approach to that letter is different. Some schools package, or they'll fill in the gap with a plus loan, a federal plus loan, and families don't know that there's options out there on the private market. So it's very, very important to know that. Just because a school packages a federal plus loan doesn't mean that families have to go that route. So we left you with a lot of information today, and hopefully we find it useful. The last page, 17, is just some helpful tips and really summarize everything that we spoke about. We're not going to talk about that in detail, but we will now turn the presentation over to Brian and for our question and answer.
The first one is going to be the client completed FAFSA and was never able to re-enter it to change schools. Any idea of an email or phone number to call to get support on the FAFSA? Is that going to be?
So the child, say it again, sorry.
Client completed the FAFSA and was never able to re-enter it to change schools. Any idea of an email or phone number to call to get support on the FAFSA?
There's a helpline it's going to the website, and there is a helpline there to be able to call to go in. I mean, you need a PIN number and all of that. But I would just I would go onto the FAFSA website, and there's a phone number that you can call. This time of year, you shouldn't have to wait too long. I mean, if you're calling, around the deadlines and things like that, you can wait hours in some cases to get help. But this time of year, you ought to be able to get through.
Okay. There's a question from Sean Kelly. Sean, can you give a little bit more clarification on your question in regards to annual contributions amount, exactly what you're looking to ask the presenters? Yeah, question's answered already. Awesome.
I may want to tell them just how to ask questions.
Does one have to go through this every year a student is in school, or is this a one-time process?
Yeah, so I always answer that they have to apply for the FAFSA every year for which they want to be considered for aid. So if you don't want to be considered for aid, no need to fill out any of the standardized forms and things like that. Now, that said, if they're looking at particular student loan programs or even some of the scholarships that are out there. Some scholarships require that you've completed the FAFSA. And the reason is that they are looking to ensure that you're not eligible for federal money before giving you private money. So I'll give you a great example just because I think we've only got one more question in the queue. We had a family a few years ago that was never going to be eligible for need-based aid. But the father had heard me say, at least in the very first year, complete the FAFSA. Always a good idea, because they may come back to you and they may say you're not eligible for any need-based aid, but they may come back with some money. So this particular girl, she was actually going to the #1 public high school in America, and this school regularly sends 100 kids to the Ivy Leagues every single year. And she wanted to go to one of those Ivy League schools. In particular, she wanted to go to Harvard. Well, the problem was that Harvard didn't really want her to come there. She was not offered admission, but she loved the idea of going to college in Boston. And so she actually went to Boston University and been accepted, didn't qualify for any need-based aid, but on a whim, I think one weekend, Dad filled out the FAFSA. And they actually, based purely on her high school GPA and her standardized test scores, she won a $19,500 grant from the university based upon that she would never have gotten had she not completed the FAFSA. And so, doesn't mean that's going to happen every time, but certainly it never hurts to ask the question. And had she not applied for need-based aid, she would not have received that that school's merit-based aid award. So I always encourage people to do it, even if you don't think you'll be able to qualify for need-based aid, because there's all kinds of things going on behind the scenes. I'll tell you, we had a family a couple years ago. Mom and Dad made really, really, really great money. They still did it. And I think in some instances, a school looks at that and says, you know what? We are never going to have to pay any need-based aid for this family based upon their income, based upon their assets, et cetera. Now, a lot of schools are need blind, but not every school is need blind. And some families, if they've got that financial data, will take that information into consideration. I'm not telling you it helps with admissions every single time, but it probably doesn't hurt. Schools thrive on what I talked about earlier, and that is the size of their school's endowment, because the endowment is what gets used to build buildings and endow professorships and to attract and retain really talented students. So bottom line, never hurts to complete the FAFSA, but the short answer is yes, you need to do it every single year for which you want to be considered for need-based aid.
Is the Florida financial aid application, the FFAA, the same thing?
No, so every state, are you guys more familiar with that specifically? I don't, Florida's got some unique programs, and here's something that's really interesting. There is the program in Florida where if your child gets a certain grade point average, they can go tuition free. They've got to have, I think it's a 1290 SAT now, and a certain grade point average. They can go to basically any in-state school tuition free. That's something that Nayfeh's own Kevin Mayu was instrumental in helping to get adopted when he was the student body president at the University of Florida. But I digress. That would be a separate form. So you need to fill that out because that's specific for the Florida schools. So that's what when I said schools have their own institutional forms, that would be an example of that at those particular schools.
Just a reminder to everyone on the webinar that the recording of the webinar will be sent out within 2 business days. Just want to have that question answered, just so you guys have that. Next question: if the 529 is in the grandparent's name, will it be accessible?
All right. So this is a sticky one. So the answer is at a FAFSA school, money inside of a grandparent-owned 529 plan does not show up as an asset. At a CSS profile school, they could ask the question, and a lot of CSS profile schools do ask what I call the catch-all question, and that is, do you have any reasonable expectation of receiving money from any other source? Scholarships, grandparents, really nice next-door neighbor, whatever that is there any other money out there that we don't know about? Now, I always get questions from people, well, can't we just lie about it? Well, sure you can. I mean, people lie on their taxes and their financial aid forms all the time, but some of those people end up in jail. And literally, if you lie on those FAFSA forms, not only can you be precluded from not being eligible for any federal money in the future, but also, I mean, you can go to jail for that. So I never encourage people to do that, obviously. But the other important piece is in a grandparent-owned 529 plan, when that money is distributed, it can count as untaxed income for the benefit of the child. So we talked early on about income to the child counts at a rate of 50% after the allowance. So you've got to do that calculation, and especially if they're looking at expensive schools. If that money is coming in from the 529 plan, it may blow them out from being eligible for need-based aid. Okay. Again, though, two things. Number one, remember that they're looking at prior year. So if you wait until the child's junior or senior year of college, it probably is never going to show up in the formula anyway. The other thing to consider is, again, draw that line in the sand first. Determine, are they eligible for need-based aid? If the answer to that is yes, then it matters if the money is in the grandparent-owned 529 plan. If there's money in the grandparent-owned 529 plan, but the family is never going to qualify for need-based aid anyway, doesn't matter.
What does a student do whose parents will not pay for any schooling when it comes to financial aid?
Disenfranchise the parents? No, I think we run into this a lot. The challenge is until the child turns 24, they cannot be considered an independent student unless there are some significantly extenuating circumstances. And so the challenge is that the child is still going to have to put their parents' information and all that. Now, every single college and university can use what's called professional judgment. And what that means is they can say, okay, here's the black and the white of the financial aid formula, but for this particular family, we are going to take extenuating circumstances into consideration. Now, look, if it's a situation where the income is really low anyway, they may qualify for need-based aid regardless. But there's something called an automatic zero EFC. There's some different formulas that I didn't have time to go into in depth today, but if you print that, do that Google search, EFC Formula 2018, you'll see all the different scenarios. But I would encourage you to work with that family, work with the schools that they're considering, and just explain the story. If it's just a situation where mom and dad say, kid, go get a job, that's a different scenario, right? I mean, again, no judgment. I mean, that for a lot of kids, that's a good solution. Go get a job and figure out how to pay for it, get some student loans, have some skin in the game. Might be a good idea for some families. But again, if the parents are just opting not to pay for it, even though maybe they could, there's nothing going to come into play in terms of additional money.
True or false question? Award letters that state the award is repeatable for all 4 years.
False. You want to, again, caveat emptor, buyer beware. You want to pay close attention to this and make sure that when a college or university on their student aid report, they say, here's this award, find out, is that a one-time award, or is that, as long as my financial circumstances don't change considerably, is this a renewable award for all 4 years? Because believe it or not, there's a little bait and switch that occurs out there in the college funding world. And some schools are notorious for saying, okay, we'll give you this $2,500 in year one, but then once we've got you there and you've made all your friends and you're on a path to a major, you're not getting it in subsequent years. So just make sure you've really defined that well with the university. Ask those questions.
And get it in writing.
Exactly. I think it's really, really important.
Is rental property in an LLC name accessible since LLC is Schedule C pass-through?
Yeah, exactly. So any rental properties, because an LLC is a pass-through entity, it is considered, the equity in that property or properties is considered to be accessible. There are some in-depth strategies where you could, if you have multiple properties, you can really create a C corporation business around it. And as long as that business doesn't have over 100 employees, it would not count. But again, that's a little complex and beyond the scope of today's conversation. Feel free to reach out to me if you want to go through that in more detail.
What would you say is the threshold for income assets to qualify for need-based aid?
It's a great question. The threshold to qualify for need-based aid, in terms, they asked about assets. Oh, income and assets. I always tell people the income, probably around $125,000 at most schools. If you're above that, you're probably not qualifying for much, if any, need-based aid. There's some exceptions. The Ivy League schools have kind of a unique formula where if your income is below a certain threshold, the maximum you'll pay is 10% of your income. So things to look at. I mean, it's easy for a school like Harvard that has $36 billion in their endowment to say, look, we want to attract the best and the brightest and not have cost be a factor in the conversation. But as a really broad rule of thumb, I'd say about $125,000. In terms of assets, again, remember that the assets count at a maximum rate of 5.64%. So, if you've got a family with $100,000 in assessable assets, not a huge impact to the financial aid formula. But if you've got somebody with $1 million in assessable assets, number one, if you've got a family with $1 million in assessable assets, more often than not, they're not qualifying for need-based aid. There are plenty of exceptions to that. But just, again, you got to know the formula to determine how to advise these families. Bright Futures. So Bright Futures, I assume you're talking about the Illinois 529 plan. Again, I think every state has their own 529 plans. So lots of different programs out there. Look at your plans, understand the rules around your state. A really good third-party website is savingforcollege.org.com. I think it's savingforcollege.com, which is a great website that gives you information about every state's 529 plans. You can learn the tax implications in your home state. Again, compare and contrast what the advantages are in-state, out-of-state. Florida, somebody was asking about Florida earlier. Florida, as an example, because it's there's no state income tax. I tell families when we speak down in Florida, look at all the available options because there's nothing that really ties you to the Florida 529 plan. Pennsylvania and Missouri are states where you can get up to a $15,000 deduction for contributions to any 529 plan. It's 15,000. I can't keep these all straight. It's 15,000 in Pennsylvania. For a married couple, they can get 30,000, which is huge. In Missouri, it's an $8,000 deduction. So, but again, any state's 529 plan. So, some pretty cool planning that you as an advisor can bring to the table.
Here's a comment from Patrick McGuire. There are always exceptions. Never take no as a no. My kids are 26 and 29. Both attended University of Michigan. My daughter ended up getting her full master's paid at 100% at Loyola by doing a JVC program and working during the day and going to school at night.
Yeah, love it. And again, I think that's so important because it's like what I tell all the time, and I get this from advisors too. When I say, look, I run this organization called the College Funding Coach, first thing that 95% of advisors say is, oh, so you do a lot of 529 plans. And while true, my opinion, the 529 plan is a little bit of a loss leader for us because college funding is the fear. What we do is we help families to solve that, right? We may use 529 plans as a piece of the puzzle, but there's also lots of other strategic planning that we're putting together to help the families build a strategy, not just to save and pay for college, but also for retirement and vacations and all those other things that families want to do. And college is sort of our door opener to be able to do comprehensive financial planning.
Next question, does geography and cost of living affect aid or formula?
Yeah, so does geography or cost of living affect it? Slightly. And what I mean by that is in that formula, again, if you go find that 36-page packet, there's essentially an allowance based upon the state in which you live. Now, here's the challenge. I live in Virginia as an example. The cost of living in Fairfax is very different from the cost of living in Danville or Bristol, which are way down in the southwestern corner. And so they give you a number that's for the entire state. And so my families with whom I work up in Northern Virginia say, well, that's not fair. Well, whether it's fair or not, I don't make the rules. My job is to help you understand the rules so that you can make an educated and informed decision around them. So again, look in that packet, you can see what it is for your particular state.
Does the EFC formula get updated annually? If so, does it really change that much?
Yeah, so the EFC formula is updated annually, and it changes slightly. So in other words, the allowances that they give you change just a little bit every single year, sort of like, you know, the tax numbers change every year, the brackets creep up a little bit each year, the amount that you can put into your IRAs grows every year, same concept. So as an example, the amount that the student can earn for this school year was $6,570. I think last year it was $6,490. So not a huge difference, but it changes slightly. So you just want to be abreast of that and make sure you're using the latest and greatest numbers. Those should be updated at least by October 1st, if not before. Usually we see them being updated over the summer, June, July, that time frame.
Well, if there are no other questions, just want to thank everyone for participating in the webinar today, but also to our presenters, Chad, Carrie, and Brock. That was great, really informative, and we appreciate you guys taking some time out for us today. And that will conclude the webinar for today. Thanks, everyone.